Buying a house. You are buying the right to live in a house and pay the bank. So people need to stop saying, oh, I bought a house, I own my house. You can't, no. You don't own anything someone can take from you, and you did not buy the house.
There has never been as much new home inventory as we have right now, going back all the way to the 2009 global financial crisis. And there has never been a time where we've had so much mind-blowing buying incentives that, as far as I can tell, are in clear violations of lending guidelines. According to Redfin's existing home data, we have hit a new all-time record high, even though this week's new all-time record high is lower than last week's. More proof of their clear bias being injected into their data and narrative, as their own data also shows that 22% of the top U.S. metro areas have plummeting home prices in some areas, as they are now showing year over year home price decline. Now, we're going to end this video talking about whether or not the big, beautiful bill is good or bad for the housing market. And welcome back to Real Estate Mindset. You guys already know this video is going to be absolutely bonkers. Mitch Vexler, how are you, sir?
This is a pretty interesting topic we're getting into, because obviously it hits very close to what it is that I'm doing on these videos with Travis. And we're going to get there at the very end of this. So just give us a few seconds or a few minutes and we'll walk you through this as to what it all means.
Housing market deals emerge as builder inventory hits 2009 levels. Speaking to an analyst last month, Lennar CEO John affirmed what other giant home builders have been saying all year. This year's housing market was weaker than they expected. And they say this: all of our markets we operate in experienced some level, again, all of the markets experienced some level of softening, whatever that means. Even in our strongest performing markets, buyers needed the assistance of incentives. Incentives will vary across the different markets, but primarily in the form of assisting with residential mortgage rate buydowns. The markets that experienced more challenging conditions during the quarter were the Pacific Northwest markets of Seattle and Portland, the Northern California markets of the Bay Area and Sacramento, Southwestern markets of Phoenix, Las Vegas, and Colorado, and some Eastern markets such as Raleigh, Atlanta, and Jacksonville. To attract sideline buyers in Q2 of 2025, Lennar, America's second largest home builder, spent an average of 13.3% of their final sales price in incentives. So imagine that for a second. You could go down on the price by 13.3%. Think about the atrocity. And think about this, guys. That's in a clear violation of multiple lending standards. Now, at that incentive rate, a home with a $450,000 sticker price would come in with nearly $60,000 in incentives. Is that not absolutely shocking? Now, the longer we've stayed in the softer housing demand environment, which has been the case since mortgage rates spiked and the pandemic housing boom fizzled out in summer of 2022, the more that unsold new build inventory has ticked up. Before you think you should go out and go buy a new home because it has some wedge and maybe some cash flow, let's listen to this recent new home buyer.
Our builder for our house has completely ghosted us, poof, gone, vanished, don't know, won't reply to us. You know, I really thought once we moved out of our DR Fort Grand house, our builder for our house has completely ghosted us, poof, gone, vanished, don't know, won't reply to us. You know, I really thought once we moved out of our DR Fort Grand house, we wouldn't have these issues. I guess I was wrong. Joke's on me. Most of you know that we had bought a new house at the beginning of last year, so February of 2024. Most of the time, whenever you buy a new build, you get that 1 year warranty where the builder has to fix anything that's wrong within that first year. We're so happy we moved in, and then boom, guess what? Brand new bathtub. It's so pretty, right? So pretty. Boom, has a leak at the very bottom underneath, and so the water comes out from underneath. Love that for us. Have I got to use that bath? No, we've used it once and my kids were the ones to use it. Oh yeah, the septic in the backyard, that has a leak too. Oh my gosh, I'm loving this. Okay, guess what? My husband texted the builder and was like, hey, we have a leak in the master bathtub, and then our septic in the backyard has a leak. Okay, he's like, perfect, great. I will send somebody else to fix it. He does. He sends somebody else to fix the septic. Septic's fixed, perfect, right? Bathtub, never fixed. He was like, oh, I'm sorry, I guess my guy never showed. Has been replied.
Mitch, based on the quality of construction reports that we've been seeing, which are not good at all, so assuming that you're going to get a new home that is going to fall apart, do you still think it's maybe a wise idea to purchase a new home, hypothetically, with, say, 25% a wedge? So 25% under market, right, wherever the market ends up, and say about a 7% cash flow. Is it a good idea to just buy a new home if it's under market value?
If you were buying a new home and it's under market value, then it begs the question, what's wrong with the home, right? So wedge or no wedge, if you're buying a new home, the theory is, well, I have the builder guarantees, I have the warranties. I would strongly suggest you read the guarantees and the warranties before you even enter into a contract. The problem with either one of them is that you must realize that there's a high probability you'll end up in a lawsuit in order to enforce them. So that takes more money that you don't have. That's part of the game. Over and above that, there's no doubt that the quality of employees at these jobs is absolutely pathetic. A lot of these builders hired people that they had no business hiring. There's a whole long story. We don't have the time to get into it into this video. But in my contracts, when I'm building, I literally have the right to take over the employees if something goes wrong. I can basically break their company in order to protect my property, my asset. Well, most people don't do that. They don't even know how to do that, most builders. So the point of the matter is, why would you take that economic risk versus saying, okay, I know that a house requires maintenance. And if I buy an older home and I am handy, I would be much better off buying that older home at more of a discount than buying a newer home that has been discounted with warranties or indoor guarantees in place that literally aren't worth the paper they're written on, because in order to gain access to the warranty or guarantee, it's going to require a lawsuit, more money out of your pocket. So the answer is caveat emptor, buyer beware.
Very good. Now let's jump into this week's Redfin housing market report, and I think you're going to find it pretty typical. This came out July 3rd, 2025, titled New Listings Pending Sales Fall as Home Prices Hit Another All-Time Record High. And so let's just go down real quick and see what this new all-time record high. So I highlighted this here. Again, look at the date here, June 29th, new all-time high, 400,125. However, they again must have forgot that last week they had an even higher all-time high. This is not the first time they've done this. You guys can see here, look at last week in the past. Okay, and not in the future, in the past, June 22nd, they had an all-time high that's higher than the new all-time high of 400,266. So I just wanted to make that quick point. Going back to this week's leading indicators, when we talk about interest rates, we are down to a daily average of 6.75%. That's down from 7.07%. Our weekly average mortgage rate is sitting at 6.67%. That is down year over year from 6.86%. This is an interesting trend because this is showing that mortgage purchase applications, even though demand is still extremely low, mortgage purchase applications, which are not closed transactions, are actually up 16%. Now, when we look at this week's winners and this week's losers, we have 22% of the top U.S. metro areas on the year-over-year price decline list, but we also have metro areas that are not on that list, starting with Detroit, which is up year-over-year, according to this data, 10.1%. Newark, New Jersey is number 2, up 9.4% year over year. Cleveland, number 3. We always see Cleveland here. That's up 7.3% year over year. Number 4 is Nashua County, up 6.3% year over year, followed by number 5, New York, up 6.6% year over year. Now, when it comes to the declining metro areas, number 2, again, surprised to see that here. Oakland is down year over year, 3.7%. Another California metro, number 2, San Diego, down 3.4%. Number 3, West Palm Beach, down 3.4%. Atlanta, down 3.2%. And Tampa, Florida, down 2.7%. These are not the usual suspects. When it comes to new listings, which is very, very important, Warren, Michigan is the leading metro area, up 9.5%. Cleveland up 7.4%, very needed for Cleveland. Montgomery County up 6%, Milwaukee up 5%, Boston up 5%. The bottom metros, which is really surprising, is Tampa at a decline of new listings of 17.6%, which is interesting. Also, another metro in Florida, Orlando down 15.8%, Anaheim number 3 down 14.3%, San Diego down 12.1%, Riverside, California down 12%. So it doesn't really look like, according to this data, that inventory as far as new listings have any indication on prices. Even though mortgage purchase applications are up double digits, it's not a closed transaction. You guys can see that pending sales are down 3%. Year over year. This is a new record low for this time of year. So demand is nowhere near keeping up pace with interest rates or new listings. You guys can see that new listings, unfortunately, are down 1% year over year. You guys can see that trajectory going down. We want that trajectory to reverse because we want even more new listings for the market, which would also indicate potential distress in the housing market. As active listings were well over 1 million and were sustained at 1.18 million, which is up 14% year over year. Supply is also up to 4.1 months, which is up 0.8 year over year. Before going to Mitch, let's listen to a TikTok video where this young woman's mortgage skyrocketed.
My mortgage went from being $1,500 to over $4,200, and that's because I made the decision to move from Michigan to California to have better weather. And it's just so crazy to me because I'm not even in a house in California. I'm only in a condo. I did some calculations. If I was to buy a single family house that's even similar, like remotely similar to what my house in Michigan was, then my monthly mortgage would be like over $10,000. And to get a house that's like kind of small, 3 bedrooms, maybe $1,500, my monthly mortgage would be over $7,000 in California. It's just wild to think how much more housing costs here, because in Michigan, it like for $250,000, you can get yourself a really decent house. Like here, you can't even get something at a trailer park for that much in Southern California.
Mitch, the housing market mathematically has never been as toxic for buyers overall than it is right now. Payment, price, out of whack. Property taxes, insurance, all those things, out of whack. People's apathy skyrocketing through the roof, which is a dangerous thing. In this market, under these circumstances, is the dream of homeownership dead?
No, the dream of homeownership is absolutely 100% alive. Everybody would like to own a home. The problem is the regulations, the fraudulent real estate tax, the fraudulent school district bonds. The combination makes the affordability, the ability to write that check every month, more difficult than at any time in U.S. history. And that's a big statement, but it's also a very true statement. President Trump, as the natural extension of the big, beautiful bill, needs to insist on the repeal of real estate taxes in favor of the uniform states sales tax, which will return the balance sheet to mom and pop such that they own the land beneath their asset and they will have something from which to retire upon. Again, a very crucial and important statement. That is why home pricing does not work. They have financed and equity stripped, so they're financing in favor of the government to straighten out its balance sheet without paying any attention to mom and pop or giving a damn. Now is the time. This is what President Trump has to do, because the $5.1 trillion in outstanding school district fraudulent bond debt is enough to take down the U.S. economy. Make no mistake, when you hurt mom and pop, you are hurting the U.S. economy. Mom and pop is the economic engine of the United States of America. This needs to be fixed. The fix is there, and that is what we are doing in these videos.
Let's go in to see if the big, beautiful bill is also a fix for the housing market. Trump's one big, beautiful bill will affect the U.S. housing market. Now, I'm just going to scroll down. I do not want to get political. He is our president, regardless if you voted for him or not. So according to this article, okay, again, just going straight to what this is saying, this bill benefits high-end buyers, investors, and professionals to benefit the most. So when I first read that, that's not good, but let's see what their point is. The tax package passed by Congress includes a provision raising the cap on the state and local tax deduction to $40,000, effectively quadrupling the previous $10,000 limit. For homeowners in certain states and metros, this could mean saving thousands of dollars in annual taxes. I have a better idea. How about just eliminate the taxes? This change, however, disproportionately benefits higher income buyers in high tax states like New York, New Jersey, Massachusetts, and Illinois region, where housing markets remain tight and prices elevated. This is also saying low income buyers unlikely to catch a break anytime soon. The bill is also likely to affect the U.S. housing market on the supply side by expanding the low-income housing tax credit and making tweaks to opportunity zone incentives. These are tools that support affordable housing, community redevelopment, and increasing housing supply, where it's so desperately needed. While these measures could help address the national housing shortage, including in rural areas and in lower income urban areas, large-scale supply-side impacts will take time and aren't likely to relieve pressure in high-cost cities anytime soon. Mitch, I don't want to just stay in these ridiculous articles. You know, as someone that has read, I don't know how well you read every single one of those 1,100 pages, but what impact do you think the BBB is going to have on the housing market?
The article is half-baked at best. So the low-income housing tax credit, the HUD 221D4, the idea of affordable housing in and of itself denotes housing for poor people. There is no such thing as a housing shortage. Again, this is another narrative. Why is housing so difficult to buy? Well, under the 221D4 program, and I actually have the spreadsheets because I reverse engineered it because they've come after me and said, would you please take our money? We looked at it and said, no. And the reason we said no is because they claim, well, we HUD are going to provide affordable housing through the 221D4 program. But that cost of that affordable housing through their program, which is creating bonds for the illusion of having Class A paper, well, that cost is 15 to 20% more than I can build that building for, apples to apples, quality to quality. Well, if their cost through the 221D4 program is 15 to 20% more, then by definition, it cannot be affordable housing. The idea that there's a housing shortage for low-income housing was a creation because the government has stepped in the middle of what would be a normal market condition. If the government wasn't there, 221D4 wasn't there, the EDCs, Economic Development Commission, is throwing money at these opportunity zones. If the government wasn't in the middle, you would let the market itself look after these conditions. The problem has become the hyper-financialization of what's going on in the middle to create the bonds necessary to get those developments on the ground. When a developer shows up and says, I've got 15% equity and I want to spend it in this 221D4 multifamily property, but I need another 15%. HUD steps up and says, we'll match your 15% with another 15%. We're going to go raise the bonds. The cost to raise the bonds, $1.5 million, right on the spot. And then it gets bigger and bigger and bigger. It's the hyper-financialization of the monkey in the middle, which is the government, HUD 221D4, HUD, that shouldn't be there. If that monkey in the middle wasn't there, the market itself would absolutely find mechanisms to create the pricing for the housing for that demographic. The idea that somebody should be denoted, well, I'm a poorer person and therefore I need affordability housing, that makes that person have the sword of Damocles over their head. It just simply isn't true. the person's position in life should have nothing to do with how they obtain their housing. Housing is a market condition. If a family earns $50,000 a year, they're going to find what is necessary, be it an apartment or a house of lower value, in order to satisfy what it is that they have. The idea, well, poor me, I don't have the money, I must depend on the government, that's wrong. It's backwards. You're a person, you can afford a house. The market would look after that if the government wasn't there, causing the cost of that housing to go up. And that comes down to some of these regulations. So by way of example, do you know that in San Antonio, Texas, the cost of a water meter is up to $24,000? That's for a water meter. You want to know what the real cost is? $780. That's a regulation. When you slap these regulations on top of this construction, on top of the outstanding school district fraudulent bond debt, on top of the fraudulent real estate taxes, the regulations, the taxes, the bond debt. This is why nobody can afford a house in today's world. And this is why I said what I said before in the prior section, President Trump. It's now time. Repeal the real estate tax in favor of the uniform state sales tax and put the nail in the coffin and allow mom and pop, all mom and pops, to own the asset beneath their feet. All of this nonsense will go away. The CADs go away. The school districts themselves go away because they're not needed anymore, right? You don't have to fund fraudulent school district bond debts. The bond debts go away. 5.1 trillion gets wiped off of the national debt. Away we go. It fixes the U.S. economy because mom and pop are the U.S. economy.
Well said, sir. And I hope that one day soon we get to, specifically you get to present your case to President Donald Trump and we can finally end these property taxes. If you guys are wondering what we're talking about, just go to our websites. Mitch's website is mockingbirdproperties.com. Mine is realestatemindset.org. Both have overwhelmingly valuable information that's absolutely free. Now, other than that, guys, if you're out there investing in real estate, your life, yourselves, whatever it is, you guys already know, we wish you luck and we hope you win.